Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to study International Financial Reporting Standard 1, or you can say Indian Accounting Standard 101. These both standards can be studied together because, as you know, Ind AS are converged form of IFRS. Therefore, the basic concepts and the principles remain same, although there are many curves between them. We'll cover them in the end of this video definitely. The name of the standard is First Time Adoption of Ind AS. So, are you ready to learn this with me? With that energy, let's begin. Let's begin with understanding what does transition year means. If we talk about India, there was some previous GAAP prevalent, applicable to organizations. It was Accounting Standard AS. The organizations used to present their financial statements according to the provisions of accounting standards. Now a shift came wherein the organizations have to prepare their standards and apply Ind AS. This shift over here is known as transition. If we talk about other countries, there were other standards prevalent that are known as previous GAAP, generally accepted accounting principle. Now a shift came wherein they have to apply IFRS, or you can say another series, that is IAS, International Accounting Standard. In foreign countries, there are two lists of standards they have to apply, wherein it has been combined. In India, it is Ind AS only, one series, and therefore to identify them differently, IFRS is numbered in 100 plus series in India. If it is IFRS 1, then in India, to identify if it is IFRS or IAS, it is always numbered as 101. Whereas if we talk about IAS, it is similar numbering. Next, from transition from previous GAAP to Ind AS or IFRS, there need multiple changes. You know, IFRS is complex concept. It needs to be applied with too much knowledge and all. There might be possibilities that the existing staff is not well versed with the provisions of the Ind AS and IFRS. So the existing staff might need training, or you might need to hire some experts to apply this Ind AS and make your financial statements perfectly correct and compliant. So staff needs training. Format of financial statement will also change. So in short, the application of Ind AS requires too much of time, efforts, and money. It is costly concept. Therefore, it is applicable to some handful companies and not to all small businesses. Now transition in FS, when we have to apply Ind AS 101, there arises a question. So every time when you need to continue such figures, then only you need to apply Ind AS 101. If you talk about balance sheet, since you know balance sheet figures, asset and liability figures are continued and carry forward to the next year, therefore to these figures Ind AS 101 will apply. But if we talk about P&L and cash flow, the figures are not carry forward. They are not carry forwarded to the next year, and therefore Ind AS 101 is not applicable on these items. Next, process of transition. This is very, very important and very simple as well. Make this clear. If asset is present in accounting standard, previous GAAP, but not in Ind AS, then what you have to do, you have to comply according to Ind AS. Make your financial statements compliant with Ind AS. Therefore, you will write off that asset that was previously present and not required as per accounting standard in the Indian accounting standards. Now, if asset and liability in Ind AS, and also in Ind AS, but valuation difference is there. It is present previously also and it is required in new Ind AS also. But the value different is there. Therefore, you will require adjustments. Value adjustment will be required. If asset liability present in AS and also in Ind AS, but classification is different. For example, previously, according to accounting standard, it was long-term liability. Now, according to Ind AS, it is short-term liability. So, a classification difference is there. You need to reclassify according to Ind AS. If liability is present in accounting standard, but not as per Indian accounting standard, now you have to remove that. You have to write off that liability, similar to asset. Next comes asset and liability not in AS but in Ind AS. It is not previously in a previous GAAP, but according to the new accounting standards, you need to apply, you need to have that asset or liability, then you need to create so that your financial statements are compliant to Indian accounting standards. Study of transitional impact. See, in the past previous GAAP was applicable, now in future new standards will be applicable, new provisions will be applicable to the same ledger. Now this ledger needs changes. Either it should be done retrospectively, that is from previous date prior to transition date, or it should be done from transition date onwards. Okay, so from onwards is known as prospective, this means onwards. Okay, and retrospective means previously, prior, or you can say prior, prior, prior to transition date retrospectively, or from onwards, okay, in the following coming years. So there are two approaches. Here some more explanation is given. Although full retrospective transition is perfect and gives true and fair view to the ledgers, okay, but at times it is not convenient to go retrospective and make all the re-estimations okay, properly, remeasurements properly. So therefore what happens, Ind AS 101 does not adopt full retrospective application. Instead it applies mixed approach, okay, for smooth transition whenever it is applicable, okay, retrospective, otherwise it asks for prospective transition. Now difference, first time adopter means, for example, there is X Limited, they used to apply accounting standards. Now they are converting their financial statements according to Ind AS. So these are known as first time adopters. First Ind AS financial statement, then transition to Ind AS. Okay, it means X Limited is first time adopter. Here very important thing comes. Generally what do? You make a two columnar balance sheet and P&L and other statements. Okay, what do? Two columnar, current year figures, current year end figures, and previous year end figures. Okay, but whenever you are making transition from previous GAAP to the new Ind AS, then according to Ind AS 101, what you need to do, you need to create your financial statement 3 columns. Okay, 3 columns, that is one more column will be added. Okay, that is beginning of the period. Okay, this means 31st March 2018, 31st March 2017. Now opening figures of this also needs to be shown. Now opening Ind AS balance sheet means any entry balance sheet at the date of transition. Date of transition to Ind AS means the beginning of earliest period. Okay, so if you talk about here in previous example, this is earliest period. Beginning of this period is known as date of transition to Ind AS, for which an entity present full comparative information under Ind AS in first Ind AS financial statement. First Ind AS reporting period means that 2018, the latest period covered by entity's first Ind AS financial statement. Deemed cost, another concept comes here. It includes surrogate of cost or depreciation cost other than WDV add-on. For example, any revaluation, any other cost will also be added and known as surrogate cost. Subsequent depreciation and amortization will be done assuming that the entity has initially recognized asset and liability at given date, that is cost was equal to deemed cost. Okay, so it will be considered that the cost, existing cost, is including all the other costs and no other adjustments are needed, and that will be considered as equal to deemed cost. No other adjustments are required. For example, if we talk about PPE, what happens? Your X Limited was there, it was following AS, and then it recorded in the balance sheet 10 lakh minus depreciation 6 lakh was the WDV. When we do a transition, okay, transition and new Ind AS are applied to the financial statements, deemed cost will be known as 6 lakh. No other adjustment will be done. Okay. Next, surrogated. I told you surrogate cost means it means over and above WDV, that is revalued, replacement, etc. cost. What is previous gap? You know this. Read it one more time. The basic of accounting, a first time adopter, used for statutory reporting requirement. Previously that it was following to make statutory financial reportings, that accounting principles are known as previous gap, generally accepted accounting principles. Scope of Ind AS 101. It applies to first Ind AS, okay, the annual Ind AS, also to the interim parts that the first Ind AS are covering. For example, see, an example is also given. For example, if we talk about 31st March 2018, this is first financial statement, okay. Now it might be having 4 quarters, quarter 1, quarter 2, quarter 3 and quarter 4. So this Ind AS will also be applicable to these 4 reportings as well. Recognition and measurement. An entity shall prepare and present an opening Ind AS balance sheet at the date of transition to Ind AS. Okay, they will be preparing this. This is starting point. This is another. Again, it is saying, you know, previous year figures, current year figures, and the opening of previous year. This is known as starting point. Here also Ind AS 101 will be applicable. Recognition and measurement is based on accounting policy. Opening balance sheet in its opening balance sheet. Okay, the same accounting policies must be used. Same accounting policies must be used. It is opening Ind AS balance sheet and through all the periods presented in first Ind AS financial statement. Okay, once you adopt it, then it will go continue in further years as well. Again, the same thing is given, that this will be known as first Ind AS reporting period, whereas here it will start from, and if once applied accounting policy, it will continue further. This is very important. If you are able to understand this table, then the Ind AS 101, you have covered it whole and it is very easy for you. Okay, if we talk about example of reclassification, for example AS, or you can say previous gap, the PPE, if you take or hire or buy any machinery, any property, okay, and if it is either for business purpose or for earning rent, the previous gap used to say that classify it always as PPE, property, plant and equipment, okay, but now new Ind AS have come, okay, and it classifies, bifurcates. If it is for business purpose, then classify it as under PPE, that is Ind AS 16, okay. Whereas if we talk about if the property is bought for rental purpose, the purpose is rental, then classify it as investment property, that is Ind AS 40, okay. So the new classification comes. This is an example of reclassification. Convertible debt, it was always classified as long-term debt borrowing, but now you have to split the equity and liability part. Reclassification, another example, redemption of preference share capital, always equity, now you have to, redemption of preference share capital is now a long-term liability according to Ind AS. Measurement, debentures rate always at face value, whereas now debenture rate means amortized cost at effective rate. Another example, measurement, intangible assets always recorded at cost, now option comes, it can be recorded at either cost or revalued amount. Lease classification, for example in books of lessee, operating lease and financing lease, 2 lease were options, okay, it depended on the situation and the terms and conditions. Now in the books of lessee, it is always finance lease, it is always finance lease except if it is low value item or up to, if it is low value item or if it is up to 12 months, otherwise always it is finance lease. Creation of asset, an example, classic example, biological assets previously according to previous gaps were not recorded in the balance sheets in the books of accounts, but now according to new Ind AS, biological assets are recorded. Derivatives, or you can say derivation, were not recorded previously, but now they have to be recorded FVTPL, fair value through P&L. Those accounting policies shall comply with each Ind AS effective at end of first Ind AS reporting period, subject to either there are mandatory exceptions or optional exemptions. Otherwise, they have to follow. What are these? Mandatory exception or exemption are what? Exception to retrospective application. Here in this particular list of situations, Ind AS says that, Ind AS 101 says that you do not need to remeasure, reclassify or make a transition retrospectively from the prior dates to the transition date. It says go prospectively, no need for retrospective, wherein this list is given: hedge accounting, non-controlling interest, that is NCI, classification and measurement of financial assets, impairment of financial assets, embedded derivatives, government loans, accounting estimates and derecognition of financial asset and liability. Okay. Next, optional exemptions are given. This is optional. Companies or organizations can choose either of them. A list is given. For example, business combination, insurance contract, share based, deemed cost, PPE, cumulative translation, difference, etc. A list is given. Two pages are there. You can read them. Your optional exemptions are available. Now, if we talk about financial asset and liability, see, there was previous gap going on. Now you have to apply new gap. Now, retrospective application is prohibited in case of financial asset and liability. So, all the classification, measurement, recognition, impairment, derecognition will be done as per Ind AS 109, and any difference arises will be transferred to retained earnings, or you can say reserve and surplus. Okay. Next, hedge accounting, previous gaps were there, now new gap. Retrospective is prohibited. So, future. Eliminate all deferred losses and gains. Measure all derivatives at fair value. Only those hedge accounting that continue to satisfy the definitions and the criteria of Ind AS 109, record them. Otherwise, eliminate them. An entity shall not reflect in opening Ind AS balance sheet anything that does not satisfy the conditions of Ind AS 109 anymore. Okay. If it satisfies, keep it, record it. If it does not satisfy, then eliminate them. NCI, non-controlling interest. Okay. Retrospective is prohibited. TCI, that is total comprehensive income. You know, P&L, other comprehensive income, if we combine them, there comes total comprehensive income, is attributable to owner or parent and to NCI ever if the result in NCI have deficit balance. Accounting for change in parent ownership. Okay. If there is change in them, they lose control. Okay. Interest in subsidiary that do not result into loss of control if there is only ownership change. Accounting for loss of control over a subsidiary and related requirements of Ind AS. This will be done not retrospectively but prospectively from the transition date onwards. Some exceptions are given. See, if an entity restates business combination as per 103 from earlier date, very important, if it restates any of the business combination from earlier dates, okay, from previous dates, then what happens? Now, then above restatement shall also be made from that date, will be done retrospectively. Business combination has optional exemption to opt Ind AS either on retrospective or prospective. It has option whether it can opt retrospective or prospective. Okay, there was optional exemptions given, and the first example was business combination. But see, now NCI has mandatory exception. If business combination chooses retrospectively, then non-controlling interest will also be stated retrospectively. This is a rule. Okay, business combination have option. It can go prospectively or retrospectively. But if business combination chooses retrospectively, then NCI also needs to be reported retrospectively. Non-controlling interest. Embedded derivatives. What are those? This has two components. Okay, integrated with a non-derivative security. One component is derivative and another is non-derivative. It has two components combined. Okay, now what you have to do? Retrospective is prohibited. Now you have to split those embedded derivatives Okay, separate the derivative and non-derivative portion, and from future onwards record it separately in the books of accounts. Record separately. Next, government loan. Now there might be different components included. You, according to Ind AS, you have to split the government loan part and the grant part, and you cannot do this retrospectively. Okay, it is prohibited. You have to do from the transition date onwards. Financial impact of first time adoption. All the financial effect will go on retained earning. If any gain or loss arises, valuation difference arises, it will always be parked or transferred to retained earnings, or you can say reserve and surplus. Presentation and disclosure. See, comparative information is required. Okay, Ind AS does not require historical summary. It never asks for historical summary to comply recognition and measurement requirements of the Ind AS. But if one is presenting their historical summaries, if any FS is presenting or containing any historical summaries, then they have to also prepare a comparative information. Also prepare a comparative information with previous GAAP and entity shall. See, two important things. Label the previous GAAP information prominently as not being prepared as per the Ind AS. Okay, you have to label that such historical summary are not according to Ind AS. Okay, you have to label them. Also disclose the nature that the main adjustment that would have been required if such historical summaries were prepared according to Ind AS. Explanation of transition to Ind AS. Reconciliation has to be made between the previous GAAP and the Ind AS. For example, okay, there is a particular asset or liability, and if you would have applied previous GAAP or the current carrying amount according to Ind AS, the gap between them is due to what amounts. You have to make a reconciliation statement. Also make last year comparative information from previous GAAP to Ind AS reconciliation. If we would have applied Ind AS to previous GAPs, or if we would have made such current financial statements also according to previous GAAP, you have to make a reconciliation between them. What is the difference that is standing out? You have to also mention these: sufficient date to understand adjustment, reconciliation that distinguish error from accounting policy, fair value as deemed cost. Ind AS 36 disclosures are also required. Further information on the interim financial statements that are covered by first Ind AS financial statements. Now, very important comes curve. As I promised that we will discuss these curves in the end of this video. Stay tuned. Okay, watch full video, you'll learn them. Okay. As per IFRS 1, basis of accounting followed before IFRS, okay, but now as per Ind AS, there were accounting standards. Carrying amount of PPE as deemed cost at transition date, we will also discuss this. As per IFRS 1, at transition date, PPE shall be accounted either using Ind AS International Accounting Standard 16 PPE or fair value, whereas here as per Ind AS 101, it is either the carrying amount or the fair value will be deemed cost. Long term foreign currency monetary item. IFRS has no other provisions, it is silent about it, whereas Ind AS 101 says either offset it or continue it. Okay, both options are given. Service concession arrangement. For example, if government is providing water, electricity, etc. at some very concessional rate, this is known as service concession arrangement, for example. Okay, IFRS 1 says follow IFRIC, that is International Financial Reporting Interpretation Committee, whereas Ind AS 101 says either go retrospectively or continue with the carrying amount. Another simple chart is given. Okay, a flow is given, so that if you follow this, you will end up doing the correct treatment of the transaction. Okay, what comes under mandatory exemption? First, see estimates required by the previous GAAP. What are they? If yes, if they were required, then see if the estimates are made and if there are errors or not. If the errors persist, then you have to make a new estimate. Okay, if error is not there, no, it is error free, then see if it is consistent with the new Ind AS that you have to apply. If yes, then continue with the previous estimates. Okay, if it is not consistent with the Ind AS, then you have to now use previous estimates and adjust according to the Ind AS. Okay, and now if the previous GAAP was not using any sort of estimates, were not required, then you have to make a new estimate. See, if estimates not required, then make a new estimate. If estimates already existing, then see if it is error free or not. Okay, error free, if it is, then apply them. Okay, no new standards required. If not error free, then make adjustments. Now, you also see that if it is consistent with Ind AS or not. Very simplified chart. Please mark this double star, read it. Again, a summary is given of the previous slide. Estimate under previous GAAP if it is present, and if it is consistent with the Ind AS, then go for the direct transit, no issue, no at all. Okay, use previous estimates. If estimates were given but error exists, then you have to make adjustments. If no estimates exist, then you have to create them. If not consistent, estimates exist, they are required by the previous GAAP but not according to the Ind AS. Now again you have to make adjustments and then apply. Optional exemptions or exceptions, you say, it can be done prospectively or retrospectively. Now, if we talk about business combination, okay, prospective means from the transition date, whereas retrospective means from prior date. If entity restate one business combination, okay, from retrospectively, then all the subsequent business combinations shall be restated. Analysis of prospective transition, cost of investment in separate financial statements of the parent company minus the share of net asset that it is having in subsidiary. Okay, the difference will be considered as goodwill. Asset and liabilities of subsidiaries are directly included. Insurance contract, you have to follow Ind AS 104 for that. For subsequent accounting, share based payment transaction. Okay, if entity shall not consider options that already vested, means entitled before transition date to Ind AS. They will not consider if they were entitled before the transition date. Okay, but if they are vested after transition date, if they are entitled after transition date, then adjustments need to be made. See, it is simplified further. Vested before transition, then ignore, no treatment needed. Entitled before transition, no treatment needed. If vested after transition, then calculate value using Ind AS and value using previous GAAP. The difference will be adjusted in the reserve and surplus, or you can say retained earning. Deemed cost of PP, we have discussed this before also. For example, investment property, only depreciated value is to be considered as deemed cost. No other value will be adjusted. As per previous GAAP, okay, deemed cost under Ind AS will be taken into account while recording into the financial statements. Deemed cost of PPE means revalued amount cannot be considered. Entity can use transition date fair value as deemed cost. This does not amount to change in accounting policy. Okay, if stand-alone financial statement of each of the group can follow different values. Okay, each financial statements separately, each entity can follow their own options. Okay, but if we talk about consolidated financial statement, then they have to follow same approach. Cumulative transition difference, option 1, entire difference through reserve and surplus should be removed, okay, should be transferred. Otherwise, what you can do is record them and then further amortize it. If entity has not exercised the option earlier, then it cannot follow and continue para number 46 or 46A, okay, is not possible. No option is given. Okay, the option was exercised before or not. This there arises a question, deal with it. If option 1 can be done, okay, that is reserve and surplus transfer, and option 2 can be taken, either record it and does not transfer this to retained earning directly whole amount, instead amortize it in parts. Fair value of financial asset and liability, it can be done prospectively or retrospectively. Hyperinflation, if any, then it can also be adjusted either retrospectively or prospectively. Okay, I hope you understood this. If you like the video, please hit the like button. If you're new to the channel, don't forget to subscribe to the channel. For any queries, doubt or suggestions, you can definitely comment us or download our app to chat with me. Okay, all the videos are available in Hindi and English, both the languages, on the channel. Separate playlist is available. Don't forget to check them out. Also, PDF notes are available. Link for the same is available in the description box. Okay, do check it out. See you in the next videos. Till then, take care, be safe, stay tuned.